All right, welcome to today's explainer for May 2nd, 2026. We've got an absolute tug of war going on in the crypto markets today. Now, before we really get into the thick of it, just a quick aside. There's been a massive legal breakthrough granting U.S. victims of the infamous OneCoin scam a brand new shot at recovering their lost assets, which is a huge deal. But our main focus today is going to be on the massive push and pull forces keeping Bitcoin trapped just under that $80,000 ceiling. We're talking macro forces, micro forces, global geopolitics, and even hidden dangers sitting right inside your hardware wallet. So let's jump right in.
So let's start with a number that is literally on everyone's mind right now, $78,348. That's where Bitcoin is hovering today. It's a staggering number, right? But the real story isn't just that the price went up. The story is about the incredible, almost invisible tension bubbling right beneath the surface that's causing this rally to stall out right there.
To really understand why we're hitting a wall, we need to break the market down. Here's our agenda for today. The global relief rally, Washington's high-stakes showdown, supply chain security threats, the AI trading reality, and finally, retail versus institutional shifts.
Let's kick things off with Section 1, the global relief rally, and how crypto is reacting to the Strait of Hormuz reopening.
The core tension playing out right now is fierce. On one hand, we've got a massive bullish push. The Strait of Hormuz has been declared completely open, oil prices are plunging, and global markets are absolutely in a risk-on mood. You think we'd be flying, but then you hit the bearish pole. There is a concrete $450 million sell wall acting as incredibly heavy market resistance. It's like this unstoppable global momentum is crashing headfirst into an unmovable brick wall of sell orders.
Moving on to Section 2. Washington's high-stakes showdown, the SEC perjury accusation. Zooming into the national level, we're hitting a massive political roadblock. Senator Elizabeth Warren has formally accused SEC Chair Paul Atkins of potential perjury regarding a decline in new enforcement actions. Now, looking at this purely from a market perspective, the collateral damage here is immediate. The highly anticipated Clarity Act is now facing severe gridlock in the Senate. With the head of the SEC tied up in this kind of investigation, we could literally see critical stablecoin and exchange regulations delayed all the way until 2030. That is a massive cloud of regulatory uncertainty hanging over the market.
The regulator may have intentionally misled the banking committee during a February 12 hearing. That specific line right there from the formal letter really underscores the absolute gravity of the political drama paralyzing the Senate today. This isn't just your standard political bickering, you know? It's a formal accusation that could completely rewrite the legislative timeline for the entire industry.
All right, Section 3, supply chain security threats. Fake hardware hits the market.
So what exactly is a supply chain attack? Well, it's a cyber attack that targets the less secure links in a supply network. Think of it like tampering with a device's firmware before it ever even reaches the consumer. You really need to grasp this concept because researchers just uncovered a highly sophisticated supply chain attack targeting crypto users right out of the physical box. This isn't some hacker guessing your password online. This is physical interception.
Here is exactly what happened. Cybersecurity researchers discovered fake ledger devices being sold on Chinese marketplaces. And when they looked inside, the firmware contained unauthorized malicious code directly linked to a Chinese semiconductor firm called Expressive Systems. This is a huge deal because it proves that physical hardware can be compromised before you even open the package. It completely shatters trust and self-custody. Honestly, this news could trigger a massive flight to safety, sending terrified users scrambling right back onto centralized, highly regulated exchanges or looking for open-source hardware alternatives.
Let's pivot slightly into the tech weeds for Section 4. The AI trading reality, hype meets hard data. $28 trillion. Jaw-dropping, right? That is the sheer amount of volume flowing through crypto's new agent economy. We are talking about AI agents making automated, on-chain payments and trades round the clock. But, as we're about to see, sheer quantity definitely does not equal quality.
While AI is fantastic at simple yield optimization, the data from DWF Ventures tells a totally different story when things get complex. Out of all the AI agent models tested, only the top 3 actually survived the chaos of open-ended trading to achieve positive returns. The rest of them? Total failure. It's a really sobering reality check. AI is not some magic money printer when the markets get unpredictable.
And that brings us to Section 5, retail versus institutional shifts, diverging strategies.
Okay, check this out. $500,000. That is the profit one single retail trader made in just a few hours. And they did it from an initial investment of barely $2,500. Wild, right?
How do they pull that off? The Asteroid token. It just rocketed past a $25 million market cap. The crucial takeaway here is that retail money is actively rotating out of those underperforming automated AI bots we just talked about and jumping right back into the pure speculation of meme coins. Traders are basically deciding, hey, I'd rather trust my own high-conviction manual gambles than a failing algorithmic agent. And because of that, the meme coin sector is showing massive, renewed signs of life.
Meanwhile, the big institutional players are doing something completely different. Insights from the Digital Asset Summit in New York show institutions are practically abandoning traditional options. Why? Because traditional options are offline on weekends and suffer from stale price discovery. In a crypto market that literally never sleeps, institutions are realizing they need continuous risk transfer. So they're pivoting hard to 24/7 equity perpetuals, which are quickly stepping up to become the dominant theme for institutional price exposure.
I'm going to leave you with this final thought. The global relief rally absolutely built a strong floor for us today. But just look at what we are up against. We've got a frozen Clarity Act thanks to gridlocked DC politics, we've got terrifying supply chain hacks threatening self-custody hardware, and we've got a $28 trillion AI agent economy that is seriously struggling to actually perform. So, are the combined weights of these headwinds simply too heavy for Bitcoin to break out past $80,000 anytime soon? That is the big question you need to be asking yourself this week. Thanks so much for joining me for today's Explainer, and stay curious.